into accounting changes and error analysis. In this chapter, we will discuss what accounting changes are and how to account for them. We will also discuss changes in estimates and changes in reporting entities and how to account for these also. We will also discuss how to analyze different types of accounting errors and correct them. In the appendix, we will discuss two types of reporting entity changes from and to the equity method of accounting. We will cover objectives 1 and 2 in this presentation, and the second part of the presentation will cover objectives 3 and 4 and the appendix. In the first learning objective, we will discuss types of accounting changes and the proper accounting for them. Consistency in accounting principles is very important to financial statements. The reason why is because companies change accounting principles, they diminish the comparability of the financial statements over time. Investors and other users have a difficult time using ratios and other analytical procedures to identify trends when there are accounting changes. Accounting for changes is based on the type of change that occurs. We will discuss the proper accounting for changes in accounting principles, estimates, and reporting entities. We will also discuss accounting for errors because they are handled like changes, even though they are not accounting changes. Changes in accounting principles include changes from one accepted accounting principle to another accepted principle, such as average cost to LIFO or FIFO to LIFO inventory methods. A change from a principle that is not accepted, such as the direct write-off method of accounts receivable, to an accepted method like allowance for bad debts is not considered to be a change in accounting principle. This is considered an error correction, which we will discuss later on. It is important to note that adoption of a new principle in recognition of events that have not occurred in the past or that were previously immaterial is not an accounting change. An example would be if the company had previously expensed marketing expenditures because they were immaterial and then began to capitalize and amortize them when they became material. The FASB has considered three approaches for reporting changes in accounting principles. One is to recognize the cumulative effect of a change in accounting principle currently in net income. The reason that this method is not used is because of problems comparing financial statements. The prior year would be on the old principle. The current year would be on the new one, but with the cumulative effect of the change in net income. The next year would be on the new principle, so the 3 years would not be very comparable. The retrospective treatment is to restate prior periods shown together with the current year to the new principle and include the cumulative effect to the change in the retained earnings of the first period shown. This helps comparability because all of the periods shown are on the new principle. The prospective approach is to begin using the new principle in the current and prospective periods with no recording of the cumulative effect and no restatement of prior periods. Thus, this method also affects comparability. The FASB chose the retrospective treatment for changes in accounting principle because it increases the comparability of the financial statements. As we discussed in the previous slide, the retrospective treatment requires that all the financial statements that are presented together use the new principle. This requires adjusting the assets and liabilities in the first year presented to the new principle. and reporting the cumulative effect of the change in net income in the opening balance of retained earnings for the first year presented. To illustrate the retrospective treatment, we will look at Dents & Company that changed its method of accounting for long-term construction contracts from completed contract to the percentage of completion method in 2020. Management believes that this approach provides a better measure of income earned. For tax purposes, Denson will continue to use the completed contract method. The enacted tax rate is 20%. This slide shows at the top a partial income statement using the completed contract method, and at the bottom a partial income statement using the percentage of completion method. We will use this information to calculate the effect of the change in principal on retained earnings for 2018 and 2019 and net income for 2020. To record the entry to show the cumulative effect of the change, we will need to calculate first the effect on the assets, liabilities, and retained earnings. As you see in the example, the cumulative effect on net income for periods prior to 2019 was calculated to be $200,000 higher under the percentage of completion method and $20,000 higher for 2019 than completed contract. This additional profit would be debited to the asset construction in process under percentage of completion. Applying the 20% tax rate to the additional amounts would equal $44,000 in deferred taxes to be credited to deferred tax liability. The reason is that the income will be reported on the tax return in a future period under the completed contract method and would generate additional tax liability, as we learned in Chapter 19. The net income amount, $176,000, would be credited to retained earnings. Because of the consistency issue, it is very important to disclose as much as possible about the effect of the change on the financial statements. First, the company needs to describe the nature of the change and the method of applying it. This includes the retrospective treatment and the effect on prior periods, including the cumulative effect on the assets, liabilities, and retained earnings in the first period presented. There also needs to be a description of the effect on the current period's net income from continuing operations, net income, and other line items on the income statement. This slide shows the note disclosure for the change from completed contract to percentage of completion. Management should explain why the change in principle was necessary, which usually should be that reporting was improved as a result. The current period effects for 2020 disclose that there was an increase in net income of $8,000 net of tax. The increase in net income for 2019 was $16,000 net of tax, and the cumulative effect as of January 1st, 2019 increased retained earnings by $160,000. This slide shows how the effect of the change on retained earnings for 2019 was calculated. The amount is different from the $176,000 we credited to retained earnings in the journal entry because the 2019 income statement will be presented with the 2020. It is important not to get confused about this. The journal entry that is made to retained earnings was for all periods prior to 2020. This included the $16,000 of net income net of tax for the 2019 year. However, the cumulative effect on retained earnings will be shown on the 2019 statement and only includes the 2018 amount of $160,000 net of tax. 2019 will be shown using the percentage of completion method, so the net income will include the additional $16,000. This slide shows the $160,000 which would be added to the beginning retained earnings for 2019 in the comparative financial statements. This is the cumulative effect of the change for all periods prior to 2019 net of tax. If you remember, the effect on net income was $200,000 before tax. The tax rate was 20%, which was multiplied by the $200,000 to determine $40,000 in deferred income tax, and the net amount is $160,000. The net income shown for 2019, $144,000, includes the $16,000 effect of the change because the 2019 statements were restated to the percentage of completion method, as well as the 2020 statements when the change was made. To illustrate another change in accounting principle, we will look at Lancer Company, which changed from the LIFO to the FIFO method of inventory in 2020. Management felt that the FIFO inventory method provides more appropriate reporting of inventory cost. Lancer went into business on January 1st, 2018. This slide shows the sales, purchases, operating expenses, and cash flows from operations for 2018 to 2020 for Lancer. The ending inventory for Lancer under both the LIFO and FIFO methods are shown for 2018 through 2020 and the differences in these amounts. It is important to note that the cumulative effect on ending inventory prior to the change in 2020 was $5,000. This will be part of the entry to record the change in a future slide. So remember this amount because it will be debited to inventory to change to the FIFO method. The cost of goods sold and net incomes under both LIFO and FIFO, as well as the differences, are shown for 2018 through 2020. The net incomes for 2018 and 2019 under LIFO and FIFO, and differences are added to calculate the cumulative effect prior to 2020 of $5,000. And the effect on net income for 2020 is $2,000. The cumulative effect of $5,000 will be credited to retained earnings in the journal entry in the next slide. The $2,000 will be used to disclose the change on 2020 net income in the notes to the financial statements. The journal entry to record the cumulative change from LIFO to FIFO at the beginning of 2020 would be a debit to inventory, which we calculated in an earlier slide, and a credit to retained earnings of $5,000 as shown on this and the previous slide. It's important to note that the journal entry is for all periods prior to 2020. The presentation of 2019 with 2020 will change the amount that is shown in the retained earnings statement, as we noted in the prior illustration, and as we will see in a future slide for this one. This slide shows the disclosure that would be reported in the notes of Lancer Company, including the reason why management chose to change the inventory method from LIFO to FIFO, and the effects on the balance sheet to inventory and retained earnings, and on the income statement for cost of goods sold and net income for 2019 and 2020. It also describes the $2,000 cumulative effect of the change on retained earnings for periods prior to 2019. Since 2019 will be shown in the comparative financial statements with 2020, the cumulative effect on retained earnings would be $2,000 at the beginning of 2019. Again, it is important to remember that the credit of $5,000 to retained earnings in the journal entry made included the 2019 effect also. This slide shows the presentation of retained earnings for the 2019 and 2020 periods. The cumulative effect of the change in methods for 2018 of $2,000 is shown as an adjustment to the beginning balance of retained earnings as of January 1st, 2019. The net income for 2019 of $103,000 uses the FIFO method, which is consistent with the retrospective approach. The FASB took the position that while it is important to use the retrospective method to restate prior statements for all direct effects of a change in accounting principle, the board did not think that it was appropriate for indirect effects. Therefore, any indirect effects of the change will be reported using the prospective approach. An example of an indirect effect would be if the profit-sharing plans require that Lancer Company pay the incremental amount due based on the FIFO income amounts. These amounts would be indirect effects, and therefore these would be reported as additional expenses in the current period, and no changes would be required for prior periods. In some cases, it may be impractical to use the retrospective treatment, such as when changing from FIFO or average costs to LIFO. In those cases where the effects cannot be determined, or where there would be significant assumptions about management's intent, or estimates required that the company cannot develop, then retrospective treatment should not be used. The new principles, such as LIFO, should be used prospectively in the current and future periods. Full disclosure would be necessary as there would be problems with consistency. In this learning objective, we will study how changes in estimates and reporting entities are accounted for. This slide shows some of the many instances where estimates are involved in accounting. You are aware from having studied accounting that we use a great deal of estimation. It is the nature of estimates that they may change over time as more information becomes available or circumstances change. These are considered to be a normal, recurring part of accounting. Because the FASB views the changes in estimate to be normal, recurring corrections and adjustments, they prohibit retrospective treatment, but favor instead prospective treatment. Prospective treatment means that you just begin using the new information in the current and, if applicable, future periods. There is no restatement of prior periods, nor is there any cumulative effect of the change recorded to the assets, liabilities, or retained earnings in the year of the change. One of the major types of changes in estimates is a change in either the method of depreciation or the number of useful years of life or residual values for assets. The FASB considers changes in the method of depreciation to be a change in estimate rather than a change in accounting principle. This is very important to remember because, as we have seen, a change in accounting principle is handled retrospectively, but a change in estimate is handled prospectively. To illustrate a change in useful life, we will study this illustration of Underwriter Labs, Inc., which purchased a building for $300,000 and originally estimated its useful life to be 15 years with no salvage value, and they used straight-line depreciation. After recording depreciation for 5 years, Underwriter Labs revised its estimate of the useful life of the building to a total of 25 years. For purposes of this illustration, we will assume that the same method of depreciation was also used for tax purposes. After depreciating the building for 5 years at $20,000 per year, which is equal to the $300,000 of cost divided by 15 years, the building had $100,000 of accumulated depreciation and a book value of $200,000 at the end of 5 years. In 2020, when Underwriter Labs decided to change their estimate of the number of years of useful life to 25, they would calculate the depreciation per year by taking the remaining book value of $200,000 and dividing it by the remaining years of useful life of 20. The new depreciation amount would be $10,000 per year, $200,000 divided by 20 years. It is important when you are working these problems to pay careful attention to how the problem is worded. If it is giving you the total useful life, you need to subtract the number of years already depreciated, like this illustration. They estimate 25 total years of life, but the building has already been depreciated for 5 of those, so only 20 years are left to depreciate. If the problem is giving you just additional years of useful life, you would not subtract the previous years. Just be sure to read the problems carefully. As we stated previously, changes in depreciation are considered to be changes in estimate rather than changes in principle. If there are other changes where it is impossible to determine whether there is a change in principle or estimate, the change should be treated as a change in estimate. It is always important for companies to make careful estimates, but if the estimates are made carefully and later are found to be incorrect, changes will be considered changes in estimate rather than error corrections. We will be discussing errors in a future slide. Under normal circumstances, companies are not required to disclose changes in accounting estimates, as these are considered to be normal recurring charges. However, if a change affects several periods, such as a change in the useful lives of depreciable assets, or it is a material amount, then the company should disclose the effect of the change on income from continuing operations and related earnings per share amounts for the current period. Changes in reporting entities are required to be reported using retrospective treatment in most circumstances. We will see one exception when we cover the appendix in a future slide. Some changes in reporting entity are shown on this slide. For example, a company may begin to report consolidated financial statements when previously they did not, or the companies within the consolidated or combined financial statement group may change, or a company may change from the cost, equity, or consolidation method of accounting for subsidiaries and investments. Using retrospective treatment would require the restatement of all prior periods presented to the new basis or group for comparative purposes. This is the end of the first part of the presentation for Chapter 22, Accounting for Changes and Error Analysis.